Hey everyone, welcome to another video. Today I wanted to talk about the looming inflation crisis that's going on in the US and what we can expect from policymakers and also from ourselves during this crisis. And, we've been living in kind of a fantasy for the last, I would say, until like 2007. This false impression that the economy is doing very well, that the consumer has never been stronger, that America is back on its feet. And in reality, it's all lies. And the United States is very good about putting out data and then portraying that data out into the world as if we are having a great time, that we're having a great party and we're going to keep partying it up. But we have a real problem on our hands. We can't produce anything in the United States without it costing a bajillion dollars more than what it costs to produce in China or in Vietnam. When you have that issue of not being able to produce your own goods and there's a supply shortage, even though you're getting items from cheaper countries, from areas that produce at a lower price, a lower cost, it's you can't guarantee that that's going to get shipped over to your little island of paradise anymore. And it's sad to say that 10% of all Americans hold 90% of all equities, of all just assets. Those 10% want that life to remain the way that it is. We're doing better than when we did like in the 1700s, when in 1776, when we took America as our own. But I mean, instead of going from 2% noblemen, 2% of the population being noblemen and the king, now we're at 10%, which includes politicians and basically smart people who invested in the very companies that make profits off of the 90% of Americans that aren't in that upper echelon. And of course, it's a gradient scale, right? I mean, the top 20% of Americans are doing fine. Top 30% of Americans, they could be doing better, but they're going to be fine. And I was looking online at the credit card statistics, and it's shocking that the total balance of the credit limit for all credit cards for all people in the United States is $4.1 trillion. And we only have a balance of $841 billion. That balance hasn't really decreased very much, according to this graph that I found on Finder.com. What that tells me is that there's plenty of room for people to continue to use their credit cards as a substitute for income, which is just false. You can't use a credit card for income. You have to pay that back. And if you don't pay that back, that's just money evaporating into thin air, which is the risk for these credit card issuers. And so you have rising prices because demand's haywire, because there's an issue with the supply-demand graph. And you've got people who literally need food, or they will, perish, and they are using their credit card to supplement their income because they're not getting raises. No one is getting raises because corporations are just going to fill their fat belly to ride out a wave of hopefully not economic depression, but from the looks of it, it could very well be a very long recession that we're heading into, because the federal government and the Federal Reserve have two very different goals in mind. One saying, literally the federal government was like, the Federal Reserve, you need to stop inflation. And the Federal Reserve is like, okay, what is my toolkit? And it's literally only taking money out of the system or raising interest rates. And by raising interest rates, it is adversely affecting the way that the federal government is run, because the federal government has only been able to run on cheap debt for the past, how long, since the 2008 financial crisis. So the federal government pays more for their interest on the interest on their loans to foreign countries and to investors. So what does the federal government have to do if they're telling the Federal Reserve, stop printing money and stop inflation? Also, by the way, bail us out because now you raise interest rates and we can't afford our payment. The Federal Reserve is like, tough luck, dude. You're going to have to figure that out. And so we have a Democratic president, and historically, this party has promoted ideas that require more funding than the government has. Currently, the government is basically all income tax. You could argue that, oh well, it's not income tax. It's the corporations are paying the employees, and they're being taxed because they have to pay the employees more. I mean, it's whatever you think it is. The money comes from one place, it's corporations, but it's income tax, and the government doesn't have enough income to supplement all of these programs that it has. And the Federal Reserve will not print more money to supply to the federal government. We're going to see a lot more government programs being shut down, like we did when Trump was elected. So however you think that's going to go, however you believe, whatever you believe in there, I mean, that's just the reality, is that we're going to have less funding for the government for two things. One, we're going to have to pay more in interest. And two, by raising interest rates, you recess the economy down. People lose their jobs. Employment's a lagging indicator. We'll see this later on in the year as these effects are taking place. You have less people working, you have less taxes being collected, or you have people going back to work, but they're making less money, which is what the Federal Reserve wanted to do the whole time. They're like, well, you said to stop inflation. We're stopping inflation. This is how you do it. And it's painful. And it happened right after World War II, and it happened in the 70s. And so we're repeating history a little bit different way, but we're doing it again, right? How does this tie back to the credit card limits? Well, I mean, you have people losing their jobs. You have people who, they don't make as much. They go back to work. They don't make as much. They're going to need to supplement their income somehow, and they're going to use credit cards, and they're going to pay the minimum payment. And I was looking at these stats. It's kind of alarming that Americans between the ages of 40 and 59 have like basically 44% of all the debt, of credit card debt, which is insane. The good news is that Americans under 30 years old have the lowest amount of credit card debt at 6.3%, which is great. There's a switch, there's a change in mindset that's coming in. And I would argue that Americans younger than 30 have the worst time with this right now, with the economy, because they're just getting out of college. They're still building their careers like me, and we're not making as much as our older American counterparts, our parents, our grandparents. And so it's surprising that, even though you would think that, just graduating out of college or just getting your certificates or, just going into the workforce at a young age and you're making less money, you have less credit card debt. There's another thing that we have to look at, and that's auto loans. And so based on everything that I laid out just now, what's going to happen with the auto loans? Well, auto loans, the current yearly auto repossessions that we're seeing are about 2.2 million from 2021, I believe. So there is a massive influx of auto repos that are occurring. And this is going to flood the market. Now, from the other YouTube videos that I watched, and remember, this is not financial advice, this is just me ranting. The other YouTube videos I watched from car gurus and people in the industry who buy from these auto shows, or they're saying that, they're seeing more cars on lots, they're seeing more cars being auctioned. These companies are trying to slowly push the cars into the market to keep the prices up. So even though there are plenty of cars that could be for sale, they're not for sale yet because they're bottlenecked artificially. And so the way to get around that is to get, I don't know if it's an auction license or you have to just join one of these auction companies and participate, but that's one way to get around it, is through that. But you're going to see car prices start to fall because they can't keep this bottleneck closed forever. If the Fed is really going to keep going with this QT, this quantitative tightening, there is going to be more and more Americans losing their jobs, who are going to be losing their incomes, and all these people who decided to get a car loan that they couldn't afford, they're going to start defaulting on their auto loans. This is going to push demand, and it's going to force that bottleneck to open at some point, because these auction lots are going to be like, hey, I don't have room. You're going to need, there's like a bunch of cars that I need to put on this lot. You're going to need to push these out. We will see a lot more of these defaults. And I'm pretty sure that eventually, probably by beginning of 2023, we will see more cars on lots, used cars, which will inevitably bring down the price of new cars. New cars being produced is just wild right now because of supply chain issues with getting parts for these vehicles. I know like part of the Audi e-tron SUV, one of the parts comes from Ukraine, and so they can't actually produce that car, which is kind of insane. So we are very interconnected. In this interconnectedness, there's a country in this world that has few countries that have brought instability. The United States is one of them. We have brought instability into the world. But there are other countries out there who have continued to bring instability, probably even worse than what we're doing, at least for now, until we raise interest rates to an unbelievable level. But we'll just see how it has to play out. Thanks for listening to my rant, guys. I appreciate it.